All right, well, we'll get started. Thank you so much for joining. So as you know, we're running a workshop today on R&D and tax. So as the economy is starting to pick up again, I think your focus as startups should really shift from, near survival to revitalising your financials to take advantage of some of the opportunities that are coming your way. So in this webinar, we've got Alex Zinzopoulos from William Buck, who's kindly offered his time to discuss the practical steps you can take to optimise both your R&D claim and your internal records to satisfy some of the substantial requirements in the event of a review. Alex will also discuss some of the common accounting mistakes that startups are making in the suite of 2020 financial year ATO reporting requirements during the next few weeks. All right, I'll leave you in the capable hands of Alex. So over to you, Alex.
Great, thanks, Beck. All right, hi everyone. You might have to put up with a bit of a croaky voice from me today and watch me drink a bit of water. Just got a bit of a cough. I have been tested for COVID, so that's all good. The actual nasal swab is anything but pleasant if anyone's had to do that. But yeah, just apologies in advance. So look, no doubt you've probably heard people talk about R&D, people probably talk about tax and accounting, and maybe they've been done in isolation. But at the end of the day, keep in mind that R&D is part of the tax, it's a tax incentive. It is part of the company tax return. So by having a holistic view of R&D and your accounts and tax together, which is the approach that we take, we find that's the best way to really get the most out of the incentive that's there to offer, and do it as part of your overall R&D and tax risk profile. Okay. So what we're going to be talking about today is we're going to look at the R&D and more the planning and the ATO side of things on R&D. We're then going to talk about some of the common accounting mistakes that I see startups do quite a fair bit. And please don't switch off when you hear accounting and mistakes. I promise you it is important to be across these. And some end of financial year reporting that's really relevant for us for startups now. In terms of questions, look, we're going to set aside some time at the end of the discussion today, and I'd be happy to go through those questions with you. If you do pop questions and I see them throughout, I'll try to answer them, but maybe towards the end is where we can devote a bit of time to answering some of your questions. Okay, so on R&D and the planning side of things, one of the common myths that I hear people say is that you start thinking about your R&D after 30 June. And that couldn't be further from the truth. So you need to look at your R&D throughout the income year. Don't consider it as something that you just do with the tax return at the end of the year. It's something that's ongoing, and all founders should consider throughout the year. And that's where the planning element comes into it. And the reason that's important is twofold. One, if you look at R&D throughout the year, it can help you maximize your claim. And two, it helps minimize risk in the event of an ATO audit or review. So when we're talking about maximizing your claim, when you start your claim at the beginning of the income year, as you may know, you need to identify what your core and supporting R&D activities are. Once you know those, then you start attributing expenses to those activities. So if you know what your core and supporting activities are at the start of the income year, you can have a bigger pool of expenditure because you can start tracking those expenses. You can start having a think about which ones will be attributable to those R&D activities. So you've got a bigger pool of expenditure to pull from, which often helps you get a bigger results in a larger claim. As you approach towards the end of the income year, there's some kind of last minute measures that you could do, which could make a huge dollar impact to your claim. So one of the few that we've got listed there is bringing forward supplier invoices. So with R&D, unless you're an associate, so unless you are in the business, if you've contracted out some of your dev work to external contractors, for those costs to be eligible for R&D, you don't actually need to pay them. You just need to have that invoice. So if you can bring an invoice in before 30 June or before your income year comes to an end, even though it's unpaid, you can still attribute those expenses to the R&D for that year. Another couple of examples is payments to associates. So I mentioned before, unless you're the founders, you don't have to pay it to claim R&D. It's the opposite for associates. So some of the things that we see is founders maybe not paying themselves a wage at all during the year. If you haven't paid yourself a wage, or if you're just kind of journaling a wage to your loan account, you're going to miss out on the R&D aspect there. So again, these are kind of the things that can be considered by founders throughout the year. So you could ask yourself, if you're looking at claiming R&D for this upcoming 21 financial year, are you paying yourselves a wage? If not, why not? Often there's a very good, there's a great benefit, because the R&D tax refund you get will likely be more than the tax you have to pay on your own, on the salaries and wages. So it's absolutely, again, it falls under this planning aspect that all startups should consider. And the other one is superannuation. So super has to be paid, not only to get the tax deduction, but to get the benefit of the R&D. So if you pay your year-end super before 30 June, it'll fall into that year's claim, and same thing throughout the year. So you want to make sure you're paying your super on time, so you not only get the tax deduction, but can get the benefit of the R&D. Those are kind of some of the main areas that we look at in terms of how to maximize a claim. So we would work through this with the startups throughout the year to identify those core and supporting activities and put some of these best practice systems in place, because at the end of the day, it can make quite a substantial difference to the business's claim. On the other side of R&D planning, I mentioned minimizing risk. So we want to try to maximize the expenditure, but at the same time, keep in mind, no doubt you've seen in the news, maybe not so recently with all the COVID measures, but before that R&D was attracting quite a few negative headlines. So you want to make sure that your claim is robust enough to be able to withstand the scrutiny of an ATO audit or an ATO review. The rules around R&D have not changed. They're the same. As much as what's been publicized, the only thing that's changed is how stringent ATO and Oz industry have been with documentation. So at the end of the day, where we see companies come unstuck with their R&D is around documentation. So if the company can have some good processes in place throughout the year, this will help them in the chance of an ATO or an Oz industry review. And it will also help them we can help identify some tips and traps. So let's have a look at some of these. Okay. When we're talking about documentation, the key word here that gets thrown around quite a fair bit is contemporaneous. What the hell is contemporaneous? I've never had to use this word before looking at R&D. Contemporaneous just basically means in existence at the time the activity was conducted. Okay, so if you're claiming R&D core and supporting activities throughout the income year, your documents need to be in existence throughout the income year. So some of the key areas of focus by the ATO and Oz industry, the biggest one is timesheets. God, that is boring, I know. And unless you work in accounting like me or law, you don't do timesheets. But at the end of the day, if you're claiming R&D on salaries paid to a CTO or someone in your dev team, they're going to be spending part of their time on R&D and part of their time maybe doing some customer-facing things, sales, maybe a little bit of BD. So how do you apportion their salary in terms of what's eligible for R&D and what's not? And at the end of the day, it's going to be timesheets. Okay, so what we encourage as best practice is we've got a template that we send around, and it's just basically if you've got any employees that are working partly on R&D and non-R&D activities, get them to complete a timesheet each week where it just puts in they complete, how many hours they spent on R&D and non-R&D activities. Okay. What we see, this is not always done. So what we usually see is businesses relying on their project software tickets. So their Jira tickets, Trello or GitHub. At the end of the day, those are kind of workflow tools or project allocation tools. They might talk about what those employees are doing, but oftentimes, one, the tickets aren't going to correspond to the core and supporting activities that are described in the project plan, in the application. And two, there's probably not a real indication of how much time that person spent on that project. So where you've got, where we can integrate the R&D application, the activities into a business's project software, we'll use that as much as we can, and we encourage that as much as we can. So if you think that you can rely just on your project software tickets alone, it's probably not going to be enough in the eyes of the ATO and on Oz industry. So if we can have project software tickets, if we can have employee timesheets, if we can have diaries, an email correspondence, anything together that corroborates how much time an employee has spent on R&D, that's going to help a business's case. And again, this is not something that can be done at the end of the year, because the ATO is not stupid. If you send them a file showing a summary of the timesheets that an employee has filled out, they will ask you for a timestamp. They will ask for evidence that that file was created throughout the year and not done after 30 June. This is by far the biggest one that we see companies come unstuck during a review or audit. The second one is experimentation. So this is actually the kind of the words behind your R&D. It details what experimentation the company's been doing. And again, it needs to be contemporaneous. So getting an R&D advisor to help with the claim at the end of the year, if there's no documentation, that's not best practice. But by working with someone throughout the year, you can actually start putting together, whether that be, again, putting descriptions in your project software, board minutes, testing reports, progress reports, anything that details the actual experimentation that's been done. And importantly, make sure that it links back to the core and supporting activities that are in your Oz industry application. And the other one there is contractor agreements. Again, best practice, as much as you've got control over it, try to have the contractor agreements make reference to those core and supporting activities in your application. Other types of documentation, so I mentioned a little bit about this, so project plan, that's something that you'd write with the assistance of your R&D and tax advisor. Progress report, your system architecture and source code documents, all those help corroborate the R&D activities you've been doing throughout the year. So the more you have of these, the better case you can build for yourself. Okay, things that we are seeing at the moment that people are getting wrong: JobKeeper and cash flow boost. Now, JobKeeper and cash flow boost may have an impact on your R&D claim. I say may because we're in discussions with the ATO at the moment. We're trying to get an answer from them, because you're looking at the technical application of the R&D provisions. If you've got a JobKeeper or cash flow boost that relates to R&D employees, that's going to come off your R&D refund. Okay, so if you've already received $50,000 or $100,000 and you're banking that you're going to get your full R&D refund based on your salaries and wages, there's a chance that might be reduced by JobKeeper and cash flow. So what we're talking with the ATO at the moment is we're saying, look, by the technical letter of the law, this needs to reduce your R&D claim, but we know that the policy of JobKeeper and cash flow boost is to help businesses. It's to get them outside on the other side of this pandemic. So it seems a little bit unfair that if they're getting this, they're going to have a reduced claim. But like I said, by the letter of the law, that's the case. And the ATO still hasn't given us an answer. They said they're going to be releasing some guidance very soon. So fingers crossed that comes in the next week or so, because we've got a whole bunch of claims that we're waiting to lodge, and we need an answer on this, because actually you can imagine it's going to have a pretty big impact on your claim. Instant asset write-off. If you're using the small business write-off provision, so the ones where you could write off assets under 20K, now it's 150,000. Beware of that, because if you're writing that off, you can't then claim that for R&D. So what we tell businesses is, as much as you can, don't use those instant asset write-off rates. Just use the normal depreciation rates. Depreciate it over the 3, 4, 5 years or whatever it is, because you can get the R&D benefit on that. You can't get it if you write it off. It's just a weird integration into a relationship between R&D and the rest of the tax provisions. Not all software dev is eligible for R&D. Founders tend to know this now. If I look back 12 months or 24 months ago, they would be claiming everything, even the bug fixes and testing, all the UI, anything that's customer facing the website, they'd claim all of it as R&D, but there's only specific parts. And if your R&D claim gets submitted and you get your refund, just keep in mind that the ATO can review your claim up to 4 years after lodgement. So if you think that you can do, I suppose, a dodgy claim and you're done with it and you're home because you got the refund, just keep in mind that there is 4 years there. And then I hope, just on the couple minutes we spent on this, that you can see that you need to have holistic R&D and tax advice. So if you're dealing with some of those boutique kind of R&D only advisors, chances are they're not going to be across JobKeeper. They're not going to be across the instant asset write-off provisions. And there's other ways as well. So there's commercial debt forgiveness. There's other ways that R&D is affected by tax. So by having someone look after both of them together, that's really putting your best foot forward in terms of documentation as well. Okay, so that's it on the R&D. I didn't want to spend too much time on that because I'm conscious that there's a lot of people that talk about R&D. So the next thing we wanted to chat about was common accounting mistakes to avoid. So you may think, who cares about accounting if you're doing a startup? Well, if you get it wrong, it's gonna distract you from doing the things that you're best at. Okay, so if you're going to spend time fixing mistakes from prior years, that's taking time away from what you should be doing for the business. Okay, you should be focusing on sales or dev or whatever your role is. You don't want to be spending time cleaning up accounting mistakes. And if you don't have the correct figures, it's hard to assess how your business is actually going and how to plan for the future as well. And where it really becomes an issue is when you're doing your next capital raise and you're doing the part of the DD, the due diligence process. A lot of these mistakes are going to come out in that time. That means it can have an impact on your valuation, or it can potentially kill a deal if there's quite a few skeletons in the closet. So look, what are we seeing? In the early days, a lot of founders are just using Excel. Excel's not a long-term solution. One, you could have the wrong formulas. It's prone to human error. And two, it's not going to be able to scale with you. So you guys have startups, you want your business to scale. As the business scales, you want software that can scale with you as well. So your zeros, your MYOBs, etc. Okay, Your cash basis of reporting. So we see that used a fair bit, and it doesn't give an accurate reflection of your business. If you don't know what your creditors are or your debtors, you're not getting a true reflection of what your business is actually worth, which has an impact on the valuation. Wrong revenue recognition. So for this one here, especially for subscription agreements, multi-year subscription agreements in advance, people often recognize all of those as revenue. Depending on what's in the agreement, it may need to be a portion, you may need to recognize the revenue over the life of the agreement. Again, it all has an impact on your valuation, and especially since you want to show that the business is growing is year on year. If you've got really lumpy revenue, it's not going to look good. Incorrect payroll setup. This one's a pain because if you set it up wrong to begin with, it can have an impact on who's an employee versus who's a contractor, how much tax to withhold, your super obligations and what's subject to super. And this one's really important because the ATO takes payroll and super and employee entitlements very seriously. So they're not forgiving on that at all. So the last thing you want is to have a payroll audit or a super audit. Being disciplined with accounts payable. I can't tell you how many times when we're doing the year-end R&D and tax return for a business, that we go through the balance sheet and it shows what their accounts payable is. And we always just get the client to confirm. And they say, oh, no, that's not right. That debt was paid off. Like, okay. Or on the other side, oh, no, that's not right. So-and-so owes us $100,000 at the end of the year. Best practice is to review your accounts payable each month. And it's not hard to understand why. One, cash flow. You want to get an accurate idea of how much money you owe or are owed over the next few months. Two, if you're including expenses in the income year, those might be eligible for R&D. So it kind of comes back to your cash basis of reporting. You want to make sure everything's been included. And three, again, it comes back to the valuation. If your accounts payable is wrong, then chances are your P&L is wrong, which means that your company's probably not going to have the correct valuation. Not tracking R&D expenses. What we see, it comes back to contemporaneous documentation and it makes the year-end process much quicker. I know Xero in particular lets you code expenses. You can track them, you can put a category towards them like R&D, sales, etc. So by doing that throughout the year, one, it gives you a better idea of an estimate of how much you're likely to get back from the R&D. And two, it makes our job easier. At the end of the year, we can do it faster, which means you get your refund faster as well. The next one here is a pain. It's a huge pain. I can't tell you how many times I've seen the cap table not agreeing to ASIC and not agreeing to the balance in Xero. When I see all three of those wrong, I just want to pull my hair out because it just has a flow-on effect to so many things. One, if you're issuing, say, options or shares, and you're using the startup concessions and you need your accountant to calculate the net tangible assets and the option exercise price, we need those figures to be correct. Okay. Two, eligibility for the startup concessions, tax deferred concessions as well. It comes back to your ESOP. You want to make sure those are correct. Three, again, your valuation. If investors are putting money into your business, you want to make sure that they want to know that the cap table is correct. They want to know what percentage they're getting. They want to know what their stake is going to be on an undiluted basis. Okay. And again, part of the DD, they're going to make sure, they're going to want to check that ASIC is right. So if ASIC is not right to reflect your shareholders and you've got to go back to update it, if you didn't update it for shares that you issued a year or two ago, you're probably going to have to pay about $1,000 or $2,000 in late fees and penalties. Safe notes and con notes, where we see that on the balance sheet. So safe notes, there's no liability to repay those. They only convert to equity. So technically, we'd want to see those in the equity section of a company's accounts. Con notes, on the other hand, if they don't convert, the company still has an obligation to repay it. It's like a loan. So we tend to want to see that in the liability section. Why that's important, again, it's going to have an impact on the valuation of your business, your assets minus your liabilities, what your net asset position is going to be. Again, when we're calculating the option exercise price for startup concessions, what you're looking to raise money at and your valuation, all those are important. And the last one there is don't be a serial late lodger. So what we mean by that is don't continually lodge your BASs late. Don't continually lodge your tax returns late. That is going to have an impact on whether the ATO is going to give you, if you want a payment arrangement or you're trying to get some interest charges remitted, it's going to have an impact there. It's something that investors ask for, whether that be R&D lenders or people looking to buy your business. They want a lodgement history with the ATO because they want to know what skeletons are in the closet. So again, this could all come out in the DD process. And if there's a lot of red marks next to your business's name, it's not a good look. Okay. Now, the final area we wanted to spend a bit of time on is your end of financial year reporting. This year is a bit different because there's new obligations for tech companies, and there's new extensions and such for as a result of COVID. So don't think of your end of financial year reporting as being the same as the previous years. It is a bit different this year. So the most important change is the taxable payments annual report. Now, what the taxable payments annual report is, it's a document that you lodge with the ATO that is a list of all the payments you have made to contractors in certain industries. So previously, it used to be to the construction industry. So, you probably know that the construction industry, there's a few dodgy people in that industry. They would Phoenix, so they'd have a company claim all your GST credits, not pay tax, then shut it down and start up a new company. They wouldn't disclose, everything would be cash in hand, so they wouldn't disclose all the payments they've made to contractors. So in 2013, the ATO introduced this taxable payments annual report for those businesses. So if you were a business in the construction industry and you had contractor payments to other businesses in the construction industry, you'd need to report all of those. It applies to contractors, subcontractors, consultants, regardless of their structure, sole traders, companies, partnerships, or trusts. It doesn't apply to employees because, as you can imagine, employees are already covered by your payroll reporting. There was nothing really to capture these contractor payments. And why this is important is from 1 July 2019, taxable payments reporting got extended to IT businesses. Okay, so 2013 was construction. Since then, it went to, I think, couriers and freight, cleaners, security and surveillance, and now it's IT. So what does that mean? What is IT? This is the description the ATO have on their website. So provision of expertise in the field of IT, such as writing, modifying, testing or support software to meet the needs of a client, designing computer systems, computer hardware, software integration, communication technologies. You can see it's really broad, and I've listed some of the services there that are on the ATO website as well. This is not an exhaustive list, but it's the ones that I think are going to be most relevant to you guys. So software dev. If you're doing any coding or writing, you're in. IT consultant, internet and web design. You can see there that it's quite broad. So if you're in that space, what that means is that if you're an IT services business, if you've made contractor payments to other IT services businesses, those are the payments you need to report. So you don't need to report all your contractor payments. You don't need to report your payments to your accounting guys or your cleaners or your co-working space. It's to those contractors who are also providing IT services businesses. So the most common one will be if you've brought on a contractor to do your work, okay? To do your software dev, the product that you own, those payments are going to be caught. So what do you need to do? This taxable payments annual report needs to be lodged with the ATO by the 28th of August. And what needs to be reported is the ABN, the name and address, and the amounts paid for each contractor during the year. So if you haven't done so, start doing that now. I know Xero and MyOb can generate the reports and handle your lodgements if you've set it up correctly. Okay, so if your suppliers, what I presume they mean by this is if you set up your supplier correctly in Xero, so you've got their ABN, the name of the address, if you're recording payments to them properly, so if you're taking up the invoice and not just doing a spend money transaction, those are the kinds of things that I imagine Xero will need for you to be able to lodge your reports. MyOb I work less with, and some of the other ones I'm not too sure, but Xero is by far the most common one that I use, and I think that's what you need to have there. And why should you care? If you don't do it, you're going to get a penalty. And if you ask, how will the ATO know? We got an email from the ATO saying this is a list of all your business, all your clients, which we believe will be subject to these measures. And they know because of the description that goes in your tax return. So when you lodge your company tax return, you need to put a business description and an industry. Your one is probably going to be IT/software, and that's all they're doing. They're data matching that and sending that out to all tax agents. So don't ignore this. The ATO will know. So the taxable payments report was the new one that was that's important for businesses this year. Some of your standard ones, which tend to get overlooked as well, is keep in mind your ESOP. So if you've issued options or shares to employees during the year at a discount to market value, you need to lodge your annual ESS reports. You need to have given your statements to your employees by the 14th of July. Don't get too stressed out if you haven't done that already. Just the key one there is make sure you do it by the 14th of August, because that's when the report is due with the ATO. And again, if you haven't done so already, collect all the relevant employee information now. So full name, tax file numbers, addresses, number of options issued during the year. Is it startup concessions? Is it taxed upfront? Is it tax deferred? Market value, that kind of information. What we see companies going wrong with ESOPs is when contractors are issued shares or options. When contractors are issued shares or options, businesses tend to think that they will automatically get the benefits of ESOPs, of the startup concessions. That's not the case. One, it can only apply to individual contractors. So if you've issued shares or options to contractors that's a company or a trust, they won't be eligible for the ESOP concessions, which means then it's revenue to them, and there's also GST obligations too. So it gets really messy and quite ugly as well, because the contractor now has a liability because they've provided some services, but they don't have the cash to pay it because you've given them options or shares and not cash. Where we also see businesses go wrong with ESOP is when founders receive shares or options. So not the initial setup, but any subsequent ESOP rounds. When founders are issued shares or options, they're not going to be eligible for the startup concessions. They're not going to be eligible for the tax deferred concessions. It pretty much means they're going to have a tax bill. And guess what? Those founders have been issued shares or options that have a market value. They haven't paid anything for it. And now they have to pay tax on that market value, and they don't have the funds to pay it. Okay, it's one of those timing mismatches between when you get issued your shares or options, you've got a tax bill to pay, but what you've received is an illiquid asset. So you're either going to have to take out a loan to pay the tax or sell some of these shares or options if you can. So again, it gets messy there. Promises made but not actioned until later. What we mean by that is it's very common for founders to speak to prospective employees and say, yeah, look, we'll give you some options. If you join us, they do a handshake on that and nothing is actually put to paper. And by the time something has been put to paper, well, guess what? That could be a few years down the track and the market value of your business could be drastically different. It's zero at day one, and it could be worth quite a lot more in the future. And again, even though it was only, even though something may have been promised at day one, unless there's an agreement in place, you have to look at what the market value of the company is when the options are legally issued. Incorrect disclosures of market value, that's an issue for your ESOP reporting. If you put the wrong value there, the ATO will data match that back to the employee, and it could lead to them having a nasty tax bill. Cap table not up to date. I mentioned that earlier. Make sure it is up to date because it affects your startup concessions. It affects your valuation. There's a lot of things that can go wrong. So make sure that's done. And the final one there is beware of using cheap or free ESOP templates. Okay, so there's no secret. The ATO has a standard agreement on their website for a company wanting to use the startup concessions. It's not very good. Okay, I don't have a legal background, so I can't comment on that. But even as a non-legal person, I can see they don't have any bad leaver provisions in there. So what that means is when an employee is issued options, what happens to those options when they leave? When the agreement is silent on it, the rights tend to fall with the employees. So that employee can leave. It could be a bad leaver in that they've done a crap job and you don't want them there anymore. And because it's not stipulated in the agreement, they can still hang on to those options and you can't get them back off them. So what we tend to see is at an absolute minimum, these agreements need to have a distinction between good leavers and bad leavers. That's just one example. But yeah, the point to take away here is when you're setting up an ESOP, just pay those extra few dollars at the beginning and get proper legal and tax advice. Your ESIC reporting. So if you did a cap raise during the year or you received some seed funding and your investors are looking to claim the ESIC tax offset on that investment, that report needs to be given to the ATO in a few days' time. So get all the info now if you haven't done that already. And like other things, the ATO is data matching. So if you don't lodge an ESIC report, but the investor is showing an ESIC offset in their personal return, that exposes you as the company because the ATO can then ask, why didn't you lodge an ESIC report? And they'll hit you with a fine. So some of the tips and traps we see with ESIC. Equity versus debt. Now, ESIC only applies to shares that have been issued. Safe notes won't count, con notes won't count. So again, that's not something that is across a lot of people's radar, which again, when you're talking to potential investors, make sure you get your tax advisor involved as well, so that you can set up the investment correctly. Careful with what representations you make to potential investors. So what we mean by that is, if you're telling your investors that your company is eligible as an ESIC, what kind of confirmation have you got on that? Most businesses will know, it leads into the next point as well about an ATO ruling versus an accountant sign-off letter. Most businesses will know that there's the 100 points test, whether you've lodged an R&D claim, whether you've got an AC grant, whether you've already raised capital before. Keep in mind that 100 points test, that's the innovation, that's the I in ESIC. You still need to satisfy the E and the S, the early stage components. So there's conditions around revenue, there's conditions around expenses and incorporation date. So don't have a look at that in isolation and go to your potential investors and say you're eligible for ESIC. It's not as simple as that. ATO ruling versus accountant sign-off letter. If you can't rely on the 100 points test, as accountants, we would prepare a letter, a kind of a comfort letter that you give to your investors that says, yep, this company has satisfied this section of the Tax Act, and it's an early stage innovation company for this year. That one's the easier one. If you can't rely on the 100 points test and you have to rely on the principles-based test, the principles-based test is subjective, which means it's not certain. So it's not as black and white as the 100 points test, it's open to interpretation. So best practice for that is to get a ruling from the ATO. We'd write that, send it to the ATO and say, based on this, on these sets of facts and circumstances, we believe the company is an ESIC for this income year, and we would get their confirmation. That is best practice because you can give that to your investors and they can hang their hat on it. If you don't do that, then you just need to convey to your investors that you haven't gotten this sign-off, and then it's up to them whether they want to take the risk to invest in it, knowing that it's open to interpretation. Timing is crucial. Just because you're an ESIC for one income year doesn't mean you're going to be an ESIC for the following income year. So don't rely on a ruling you've got, say, for the 2019 year and apply it to the 2020 income year. Speak to your tax agent. Group structures are problematic. So if you're a standalone company, then that's a lot easier. But if you've got a group, so maybe you've got IP Co up here and you've got Trading Co underneath it as a subsidiary, or maybe your holding co is just a shelf company that doesn't do anything and you've got IP Co and Trading Co underneath. The ESIC rules look only at the top company. So if your top company is not doing anything other than holding the shares in the subsidiary, it's very hard to say that it is an ESIC. So that's where we'd go to the ATO and get a ruling. And finally here, watch how your accounting is done. There's a condition that a company can't have more than $1 million of expenses in the prior income year. Otherwise, it won't be an ESIC. So where it's within reason, of course, get some guidance from your accountant about whether those the costs should be in your P&L or whether they should be capitalized on your balance sheet. Okay, payroll, I'm not going to bore you with this one. There's the dates on here about when you need to finalize your end of year declaration if you're using STP, and when to finalize your PAYG payment summaries if you're not using STP. And where we see companies going wrong with payroll is they've got the wrong payroll category set up in their file. So maybe things like allowances and bonuses are very common to get wrong. Make sure they're set up correctly so then they've got the right treatment for super and PAYG withholding. Tracking of leave, too often that I see, especially in a business that's just run by founders and doesn't have any employees at this stage, they're not keeping track of their leave. It's not a default setting in Xero. It's something that you've just got to it's something that you've got to implement. So where you've got leave not on Xero or MYOB, but then your payroll is in Xero and MYOB, strongly encourage you to integrate those together. The next one here is a manual check. It's not something that your Xero file is going to know. Your reportable super and reportable fringe benefits. So reportable super, if any employee is salary sacrificing, and reportable fringe benefits, and if anyone's got a car, those need to be disclosed in the payment summary. And especially now with the transition from PAYG to STP, we're seeing a few businesses getting it wrong, especially this income year. Okay, finally, before we go to questions, payroll tax. If you've got enough employees that you're paying over 900K in wages and super for the year, keep in mind you've got to pay payroll tax at 5.5% over that amount. Your annual payroll tax rec is usually due 21 in July, but with COVID, it's now due 30th of October. And some tips and traps: if you've got interstate employees, you'll probably need to do multiple lodgements, and there's different rates to apply. Careful of JobKeeper. JobKeeper is going to have some specific payroll tax treatment, depending on whether your employees are earning less than $1,500 or more than $1,500 in the fortnight. If you've got an ESOP, this one I see overlooked all the time. If you've had an ESOP and you've issued shares or options during the year, even though they may not be worth anything under the startup concessions, you still need to include the market value of those for payroll tax. Okay, and we're not talking about the option exercise price here. It's its own independent valuation. Fringe benefits, keep that one in mind. You need to report that in your payroll tax. And grouping provisions. So if you've got multiple companies, if you've got any companies that have common use of common employees or premises, suppliers, if you've got a family trust and your company is a potential beneficiary, the grouping provisions are very broad, so speak to your accountant about that. Okay, so look, that's the part that I wanted to go through on my end. We've got about 10 minutes left, so I'm happy to jump to any questions now. I haven't been checking the chat box, so I'll do that now. Eric, can timesheets be in Excel? I'm assuming this is for R&D. Yes, they can. We've got a template that we use. The most important thing is just to make sure that they're tracking the number of hours that employees are spending on R&D activities and non-R&D activities, so you can get a portion, a breakdown between the two. And Olga, do we need to lodge a TPAR if our subcontractors are overseas and do not have an ABN? No, you don't. So the point of TPAR is an Australian tax perspective obligation. If your subcontractor is overseas and they don't have an ABN and they conduct their services overseas, then you don't need to lodge it. If your contractor doesn't have an ABN, but you think they should because they're performing anything here in Australia, then that's when you wouldn't need to second guess it. But your typical overseas contractors, no, you don't need to report that. How to calculate market value, any recommended docs from Jacob? So I'm assuming that's for the purposes of ESOP. Now, for your ESOP, if you're relying on the startup concessions, one of the benefits of that is you can use the net tangible assets of the company. So what's on your balance sheet? Assets minus liabilities. So given that startups are generally loss-making, their net assets is probably going to be negative, which means you could issue an option with a minimal strike price, like 1 cent or 5 cents. Again, don't just take that on my word. You do need an accountant to prepare that for you to sign off on it. But that's for the startup concessions, and it's one of the greatest benefits of having that. If you can't rely on the startup concessions, or if you need to include your options in your payroll tax return, market value, the ATO and the OSR don't have any definitions or guidelines as to what market value is. Sorry, let me rephrase that. They don't have any strict requirements as to how to calculate market value. You just need to be able to support that the amount is what would be reasonable between two unrelated parties. Best practice would be to get an independent valuation done. Obviously, if you're bringing in a valuer like a corporate advisor or something like that, they're very expensive. So independent valuation is best practice, but it's not mandatory. What we see other businesses relying on is the Black-Scholes method. The Black-Scholes method, depending on your vesting criteria, it can give you probably not a very favorable outcome. It can go either way. And your other option is to use the ATO valuation tool, but that is probably not going to get you a good outcome as well. So the key thing for it, what we tell our clients is use the startup concessions for the purposes of tax. That's going to get you a great outcome. And then what we do, if you want to use the market value to calculate your options or shares for any other purpose, we do get our corporate advisory team. They'll do a one-off template that they create. So it's not a full-blown independent valuation. It's just a template that we give to the client that says you put in all your key criteria, so dates, vesting conditions, cliffs, exercise price, etc. And using that data, it calculates what the market value is, pulling in different methodologies. So it pulls through the Black-Scholes method, it pulls through the ATO's method and a few other ones. And then the clients can have it, they see it, and then they've got a few different options there as to what would be the market value. And we haven't seen that being challenged by the ATO. So that's another option there. Okay. Any other questions? Feel free to put them through the chat box or unmute and ask me directly.
Hey, Alex, this is more of a clarification than a question, but as part of the ESIC point innovation test, do startups get 50 points for being part of an accelerator program?
Yeah, so it comes back to the terms of the accelerator program. What you want to see is that the accelerator program has been around for at least 6 months. The accelerator program provides time limited support, i.e. the businesses have to, they can't hang around forever. It's a set period. And the third one is that there's been at least one cohort that's gone through.
Yeah.
Okay. Where those three have been ticked, then any other businesses that come through that accelerator automatically get the 50 points. If you're not sure, you know, Beck, at that kind of launchpad level or other accelerators, what we do sometimes is work with the accelerators, even do a ruling with the ATO, just for them. They can say, yep, this accelerator is an eligible one under the ESIC test. And that way you've got something to be able to give your cohort.
Awesome, thank you.
Okay. Any other questions? Okay. So look, one of the takeaways from this, which I hope has come through, is when you're dealing with R&D, tax and accounting in particular, I strongly encourage you speak to someone who does all of that, because it's really easy for something that's R&D, that if you got an R&D advisor, they may not consider some of these tax issues, they may not consider some of these end of year reporting, and vice versa. So having that holistic approach is always recommended.
All right, amazing. And thank you so much for your generous time, Alex. I hope you guys found that helpful. So just to recap, I will make this recording available afterwards, as well as the slides on Launchpad Live, so you can access it through there. And I'll also share Alex's contact details as well if you want to get in touch.
All right, thank you all. And I noticed my voice starting to give out towards the end, so I hope it wasn't too croaky, and thanks for putting up with me.
No, you did well, Alex. Thank you very much.
Okay, thanks everyone.
Thank you.
Thank you all. Bye.